A lot of groups were doing floating rate debt, but they thought the difference is in commercial real estate, we can buy an interest rate cap, like an insurance policy. So we protect ourselves against rising rates. The problem with those is you have to buy them up front and you have to pay per year, right? You could get a 1 year cap, a 2 year, a 3 year, a 4 year. Well, you don't want to overpay. So if you think we're going to get in this deal and we're going to exit it in 3 years, then why would you buy a 5 year cap? You probably wouldn't, right? But the issue was, again, back to 2020, you're buying this deal with a 3 year cap and now it's 23 and rates are a lot higher. You have to renew the cap. And a lot of those went from ballpark numbers, 100,000 per deal for a sizable apartment community, up to $1 million for the renewal. So all of a sudden you're having to come out of pocket $1 million you didn't anticipate having to come out of pocket for, or you're having to work with your lender and maybe, adjust the loans on here, but hopefully avoiding a short sale. So fixed rate in hindsight, of course, would have been the way to go.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Travis Watts. Travis is a multifamily apartment investor, public speaker, and the director of investor development at Ashcroft Capital. And in just a minute, we're going to speak with Travis Watts about lessons learned through the market cycle 2022 to 2025. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome back my guest, Travis Watts. Welcome back to CREPN Radio.
Thanks so much for having me back. Thrilled to be here.
Well, I'm always delighted to see and talk with you, and looking forward to another good conversation. But just in case some of the listeners don't know of you, if you could take a minute and give a little bit about your background.
Sure. Yeah, happy to. So these days, I'm a full-time limited partner, or what some call a full-time passive income investor. Been doing that for roughly a decade at this point. And prior to that, I was just a real estate guy doing do-it-yourself projects, right? Had some Airbnbs, some buy and hold, some fix and flips. I was doing everything on my own. So figured there was hopefully a better way to scale the passive income, be a little more hands-off. And so I dedicate my time to teaching others the business from the LP side of things. And as you pointed out, I also work with Joe Fairless at Ashcroft Capital. Done a multitude of roles over there since 2019. So again, just kind of operating both personally and professionally in the syndication space, and a lot in multifamily.
Got it. Well, the topic we want to jump into today, lessons from the market cycle 2022 to 2025, I think are it's a good review point. I know I've been doing this podcast. I started it vaguely in 2000. I want to say it's 2014, but I know 2015 for sure. And when I first started having conversations with people like yourself, I remember specifically talking with some people at some more market analysis data type environments, and their sense of the market was that we were at the end of a market cycle, and that but instead of it being the end, there was like extra innings, comparing it to like a baseball game.
Right.
And and then as that conversation continued, they said it's like we're in a doubleheader. It's the second game because we haven't had the dip that would normally occur in a normal market cycle. And I know that since that time, there have been some things that have kind of interrupted a normal market cycle. The COVID situation, the COVID cash, and all of that. And so I think for perspective in this conversation, it's important to kind of identify where we were in 2022 in terms of the whole market cycle, and maybe even step back one second just to identify what are the different points in the market cycle, and then identify where we were in 2022. Does that make sense?
It does. Yeah. Happy to address those. Yeah, not a lot of people are talking about this kind of macro level of it, but when I started in '09, I was catching a falling knife, and meaning that real estate prices were still on their way down. And to your point, I wasn't going to sit there as a novice entry level real estate person trying to pretend like I could time markets or know where the bottom was. What I did know is the fundamentals of the deal that I was buying. I bought this little 2-bed, 1-bath townhome in a college town, and I thought, well, I can get a roommate, right? And I knew my mortgage, and I had fixed rate debt, and I knew what I could charge, for a furnished unit, to a college student. So that's what I did. And, it made sense regardless, even if that property continued to fall and fall and fall, and then one day eventually recover. That wasn't what I was trying to do, is to try to time the in and out. I just need a place to live, and I was getting a lot of my bills covered through cash flow, So the way I look at this cycle, to your point, yes. I mean, when I went full-time LP, there was a lot of operators and GPs calling for the market cycle to end, people, the Kiyosakis of the world and whatnot, calling for doomsday and biggest stock market meltdown you've ever seen. And it's just really hard to time, and so I just took this perspective of, I came also from a stock background, with Wall Street stuff and brokerage houses and dollar cost average. I think a lot of us buy into that philosophy in stocks, but then when it comes to real estate, we don't, for whatever reason, but it's really no different right now. So the way I see it is, I bought in '09, and it really wasn't until about 2012 that the market in terms of real estate really started to recover. So the way I look at that in my own mind here, it's just kind of my own, perspective on this. 2012 to 2022, it, in my version, was the bull market. It was the next phase of the real estate run. So most of us got in during that period of time, and unfortunately, a few of us got in at the tail end. And so we'll talk about that. But you can expect, depending on the asset class, on average, historically speaking, that cycles happen about every 10 years. Now, of course, that's dependent on what specifically we're talking about. So we had a solid 10-year bull run in real estate. So we should all be thinking at some point, not necessarily trying to time the market, but just be considering the fact that the market will probably shift at some point. So what happened in 22, as we all know, and we'll back up to 2020 because the market really started to shift there. So obviously the unprecedented, pandemic and shutdowns and layoffs, and that was a scary time. And we saw an immediate softening followed by a pretty robust recovery, thanks to, the Fed and printing money and all this kind of stuff, which boosted all asset types. I mean, you can go back to 21 and look at crypto and stocks and real estate. I mean, what wasn't flying high? That was just artificial money in the system needing a place, to go. Then in 21, we were starting to see what I considered red flags, which was double digit rent growth, and some of these assets were just appreciating way too fast, compared to our business plans of maybe a modest 2-3% a year rent growth. We were seeing 12, 13, 14, even 15% in some of our Florida properties. So that's a little scary, because you think, where does this end? And just like with stocks and the dot-com bust and the AI bubble, and where does it stop? We don't know, right? So 22, inflation starts to rear its head, double digit inflation just about. And so the Fed comes in to hike interest rates. And now, in terms of commercial real estate, but also stocks in 22, it was kind of a down year. Crypto was down, stocks were down, real estate's down. But real estate's a very slow moving ship. So it didn't just drop like a rock and then stay at the bottom. It drifted down in 22, and then it drifted more in 23, and then it drifted more in 24. Now, when you're bottoming out in a real estate cycle, one, it takes many years, as we just discussed, but two, an average time frame is close to a 3 to 4 year period. And we could go back to the great real estate recession and kind of eyeball that as a case study. 08 was not a great year. 9 was not a great year. 10, 11 weren't great years. But by 12, we're in a recovery mode, so it's just a matter of time. So for everybody listening right now, if you haven't, if you've been passing on deals in 23 and 24 and 25 so far, just know the odds are now shifting more into your favor of a recovery happening sooner than later. And we'll talk about that, I'm sure, more on the show here. But I guess what I'm trying to say is, none of us should fear market cycles. I mean, if you truly are fearful, or you can't, afford any type of losses or pause distributions, just remember that the risk-free money pays you about 3 or 4%, and it's declining as we speak. So that's always an option if it's going to get you to where you want to be. But I just try to dollar cost average. So I've got a handful of deals that have done very well in the last 5 years, and a handful of deals that haven't done so well. So it's all kind of an average when you shake it out long term, if you stay in the game.
Right. Well, and I appreciate you kind of setting that up from just a dollar cost average mindset, because I think that, that, like you said, that is um, a welcome, understood viewpoint from like the stock market, but not necessarily apply it on a regular basis to real estate. And I think part of that may be that people are always looking for the big home run in real estate, like in the, whether it be a flip type thing or get in, get out kind of thing.
Yeah.
Versus I tend to view it more on that dollar cost average, not because, not necessarily like I would necessarily like on a like a 401k where you're buying every month,
Mm-hmm.
kind of thing, but just the long term nature of real estate. Like you mentioned, it's kind of a slow downward, and also typically a slow upward. It's not, you don't usually get these spikes that go up and down unless there's something that's really consequential in the market, like interest rates, or like COVID, where all of a sudden a bunch of people are looking to move to a particular space that doesn't have room for them, and all of a sudden the demand spikes, and the, like you said, the rents are climbing like they were. So, but from a long-term perspective, I remember the first rental I bought, the simple math I could do in my head was that if I bought this property today and the numbers worked, that over the life of that loan, and I just held it, did nothing but just held it, maintained it, kept a tenant in there, that they would pay off my mortgage.
Mm-hmm.
And at the end of, and I wasn't even figuring in on appreciation.
Right.
I
Smart.
was just
Yeah.
figuring, well, it was just I didn't have that, I didn't have that education. I didn't have that understanding. I was just more of looking at like a declining balance, like essentially they were contributing to another 401k for me, or another retirement account.
Yeah. Yeah.
And, so from that kind of a vantage point, uh, all I saw was an increase in equity point, not an appreciation, just the debt was lowering, the equity was increasing based on retiring the debt. And but clearly that's a long-term view, because especially in the first couple of years of a loan, there's not a lot of equity build A
Yeah.
lot of that's going to the bank. Um, but I guess that's always been kind of my I guess my that's more I wouldn't say always, but that's been kind of more of where I started looking at real estate was kind of more of the long term viewpoint. Um,
Yeah.
and I wonder if you have any kind of a sense of you know because I feel like especially like with syndications and stuff where you're pooling a bunch of investors' money together
Hmm.
and there's a promise, a commitment to those investors to exit the deal within an X number of years. Um, do you think that necessarily, I guess, changes like one's investment viewpoint? And I'm not saying it's good or bad. I'm saying from a standpoint versus if you buy a property and your intent is to hold it, in your portfolio, does that change your perspective?
That's a great question. And I think before all this crowdfunding and all of these, law changes that happened around 2012 to 2015, I mean, it brought a lot of people into the syndication space, is what I'm trying to say. And prior to that, if you kind of look around at so-called syndication, which was not a very widely known term or understood one, a lot of the groups were these buy and hold kind of forever groups, right? Not to say that they literally will hold it forever, but they just didn't project an exit. The game plan was let's cash flow. And if and when it makes sense to do a refinance, we'll do it. We'll send back as much of your capital as we can. And at some point, hopefully, you achieve what some call that infinite return, where you've now gotten all of your original investment back, but you continue to stay in this deal and cash flow. It's a beautiful model. When it works in your favor. What's worked against everyone with these 5-year business plans, which is typical for a value add deal, is that you bought, let's say in 2020, and now it's 2025. There's your 5-year plan, right? Well, the 5-year plan went out the window because as we sit here today, values are down 20, 25%, sometimes even more in other markets, more in other asset types like office, in some cases. So it's not a good time to exit, right? Even though investors were expecting 5 years, you're sitting here today going, geez, if we sold, we're going to have a break even or maybe even a loss. It's just not a good time. So hopefully you're able to hold on to these properties for the market recovery. And it's a hard lesson for all of us, LPs and GPs, that, the market dictates a lot. As someone pointed out once, I forgot who coined it, but it's like you never lose money in real estate unless you're forced to sell in an inopportune time. That's kind of right now, so everyone who's selling for the most part is taking a pretty substantial haircut on these properties. So, some of those lessons that came out of that, if I extract them real quick, is a lot of groups were doing floating rate debt, but they thought the difference is in commercial real estate, we can buy an interest rate cap, like an insurance policy. So we protect ourselves against rising rates. The problem with those is you have to buy them up front and you have to pay per year, right? You could get a 1-year cap, a 2-year, a 3-year, a 4-year. Well, you don't want to overpay. So if you think we're going to get in this deal and we're going to exit it in 3 years, then why would you buy a 5-year cap? You probably wouldn't, right? But the issue was, again, back to 2020, you're buying this deal with a 3-year cap and now it's 23 and rates are a lot higher. You have to renew the cap. And a lot of those went from ballpark numbers, 100,000 per deal for a sizable apartment community, up to $1 million for the renewal. So all of a sudden you're having to come out of pocket $1 million you didn't anticipate having to come out of pocket for, or you're having to work with your lender and maybe, adjust the loans on here, but hopefully avoiding a short sale. So fixed rate in hindsight, of course, would have been the way to go for everybody. I've been in some of those deals throughout this entire cycle. In fact, almost 10 years I've been in some of these deals. They continue to cash flow, to your point. They continue to produce income. We're not looking to sell. We're not needing to sell. These loans have been amortizing for years. So we've been paying down debt every single month. So our LTV on some of these is like 50%, so we're not at risk with those deals. Other deals that were bought on bridge debt in 21 and 22 at all-time high pricing are really struggling. We've seen capital calls, some foreclosures, stuff like that. So, Yeah, I mean, but back to your point, one thing I wanted to say about the market cycle, you hit this, I forgot to mention this a few minutes ago, but the euphoric period, which is always the peak of a cycle, and again, doesn't matter if we're talking stocks, real estate, crypto, whatever. Euphoria was like 21. Money's getting printed, optimism's back, things are reopening, things were good. Anxiety kicked in 22, which is the next leg, and it's shortly a leg down from the peak. And anxiety was just about inflation is here, the Fed says they're going to start to raise rates, we don't know how much and how soon. 23 was kind of that denial period. Is this really the end of the bull run? Is it really over, or is it just a little modest dip? 24 was the panic, kind of the capitulation, which continued into early 25. And now we kind of sit at the bottom, but we're looking at, thankfully, the beginning signs of a recovery. Very high absorption rates, to name one. High demand among renters is what that is. Low new supply coming to the market as we look forward. When you look at permits and how much building is going to take place in the next 2-3 years, very, very small percentage of what was taking place previously. Occupancies are starting to stabilize. Cap rates in many markets are starting to compress, which is good for valuations, growing transaction volume, and forecasted rate declines on the horizon. So it's basically everything that was bad about 22, 23, 24, and early 25 is now pivoting to be almost the perfect storm in the other direction, which is a positive, right? It's like everything you could ask for is coming back. Rent growth is starting to trickle up, stuff like that. So that's kind of where we stand today. And again, I can't help but compare and contrast the stock world. It's like we're having a conversation about stocks in 2011 or something like that, after the bottom, after the capitulation, after all the bad news, and we're starting to look at, what might be a positive here for the future. So I think, as we all know, buying the dip often results in the best returns long term. But again, I don't even try to time anything. I invested, in 21, 22, 23, 24, 25, and just kind of doing the averages as we go.
Yeah. No, and even in that, I think, as you identified, as long as you have a mental, or mental and also capital capacity to wait out the market cycle, there's no reason for you to lose. It's more if you come up in a situation where you have to sell, or the deal is structured in a way that, like I said, you had some bridge loan or something that requires additional capital, to make it through to the other side. But yeah, like I said, if the deal works, on the fundamentals when you buy, and your debt is structured in a way that you're not at risk of running out of term, then I think I believe that you can be in a good spot. And like I said, as the cycle start, I guess has anybody said we're at the bottom of the cycle, or is it just kind of more of evidence based on what we've seen the last couple of years?
Few groups have called it, according to them, of course. I'm not saying that's the official word, but I mean, I think it was Goldman, maybe it was JP Morgan. I'm trying to think. There's a few of these large mega institutions, BlackRock or Blackstone may have called, and basically somewhere in 24. No one ever knows exactly until hindsight is completely over and we look back and go, yeah, that was the bottom. But my guess is it was sometime between the summer and the winter of 24. Still some falling out happening this year in a relatively soft summer. But again, some of those things I pointed out, like we haven't seen this strong of demand in most markets since, the record-breaking year prior was 2021, when things were just starting to fill up again. Prior to that, it was a long time back. So the bottom line is, it wasn't just a catastrophe of multifamily. The single family home market continued to be relatively robust. And now a 3% mortgage became a 6.5% mortgage, but the home price continued going up on top of that. So many people, I mean, we're talking millions upon millions upon millions of American people priced out of the home ownership market. They have been for years. They continue to be. There hasn't been the relief they've been looking for. Apartment renting, in my opinion, makes a lot of sense for a lot of people right now. Now, and by the way, when I say that, I've been on both sides of this coin. I've chosen at times to be a homeowner when it made sense based on fundamentals like we're talking about. And I've chosen to be a renter throughout that period too. I've gone back and forth depending on what we're doing, how we're living our lives and stuff like that, because it could just make a lot more sense. Prime example, we lived in downtown Denver. These high rises were selling for, these little apartment things were selling for like $1 million. Well, we found a rental for like 2,500 a month. So it's like, do you want to fork up $1 million and have an HOA and all these property taxes and insurance and all this stuff, or do you just want to pay 2,500 a month in rent and have total flexibility, freedom, etc.? We chose to rent in that instance. So that's why we're seeing such robust demand. And thank goodness fundamentals have held up, at least thus far in multifamily, and pricing power comes back when rates lower. That's the single largest factor. And NOI starts to bump as we get rent increases to happen, which have been relatively on pause for several years now as we've gone through this cycle. So again, we've just been waiting and waiting and waiting and waiting. And if you kind of look at historical averages, real estate recessions, 3-4 years on average, and we're there. In fact, we're a little beyond it. So in some cases.
Well, and another thing I wanted to touch on that you mentioned was the absorption and the demand. I think one of the unique things about real estate is if there's demand today and you decide you want to build something, it's not like you just go out and build it tomorrow and then next week it's available for rent. I mean, there's the time, the lag in the timeline in order to get that new product to market. What is a typical for a new build? Is it, I mean, from the day you break ground, not the permitting and not all of the design work and all that, in front of that. But I mean, I'm assuming 18 months at least depending on how large the project is. Is that?
I think 18 months would probably be that initial little powwow of a business plan. The reality is it's usually more like a 3-year period. It depends, of course, on the size, but what often happens with new development is a lot of delays. And it could be anything. Permits, waiting on this, contractor that, setback over here. But in general, 3 years for a larger community. So that's been the story of the last 2 years, is that these builders started getting heavily involved in 21 and 22 at peak pricing, whenever all the money's rushing in, and it took them this long to build. And now those properties are hitting the market and needing to fill up. And so that's kind of been, this oversupply has really dampened the outlook of multifamily in the short term. But thankfully, that's a short-term problem, to your point, because all you got to do is look at new builds and permits of 26, 27, 28, and you see this falling off a cliff, which puts us in an interesting situation all your listeners should think about. If you're getting in a deal today with peak supply hitting the market and short-term softness, and you're buying the dip, and you got your fixed rate debt and your positive cash flow, what happens 3 years out if demand remains robust, right? And builders aren't building, and this game is really a supply and demand game, at the end of the day. So it's something I think about a lot. It's something that makes me bullish. Here's how I frame it. It's like, everyone can understand a single family house as a rental. So it's like I get offered to buy this rental property, but the problem is right now there's a tenant in there and they're not paying their rent. But because of it, I'm going to get $100,000 off the purchase price. Let's just, artificial scenario. Short-term pain for long-term gain, right? I'm going to have to weather the storm maybe 6 months, get this tenant out, fix some stuff, value add, turn it around. But eventually, I'm going to see and recognize that value on the back end. So that's kind of, in a weird way, kind of what we're looking at in commercial real estate to a point. Yeah.
Yeah. I think that just that all by itself, I mean, interest rates are definitely what I find that really drive the ability to buy, at a higher price. If interest rates are under control, the buyer can afford a higher price because the payment is the same or less than it would have been at a higher interest rate.
Yeah.
And that's kind of a, and I feel like the market. I remember reading books, um, you know, probably 20, 25 years ago, talking about real estate, and they were talking about 8% was the cap rate. Period. It was just market rate was 8%, but also interest rates were, um, much higher. And what the time period we've been talking about, we've had unprecedented low interest rates, that were
Yes.
really fueling that market, which then compressed the cap rate, which, pushed the valuations up so high.
Yeah.
And so I think that, the funny thing is that Americans and investors, we tend to have kind of short memories. You know, you
Yeah.
you uh, you remember the time, but then you don't always remember the bad time, and what caused the bad time. And then if we do remember it, we're looking for exactly what happened last time to happen next time. And
Right.
it's rarely the same thing because there's a new variable because we fixed that problem, last time. And so
Mm-hmm.
it's, the cycles. I think kind of where I'm at, and what uh, I'm not, I don't want to say I'm comfortable with, but kind of an expectation is just recognize. I think, when interest rates are low, people are going to borrow more money. Builders are going to build more because, you have this, when demand is high, they're going to, work to grow the supply, take advantage of the demand.
Mm-hmm.
But that demand is not always satisfied when demand is high and interest rates are low. It's, that lag all of a sudden when it presents itself, it's like, the other variables that were driving that cycle could be an inverse, and all of a sudden you have this upside down reality with the, high supply and high interest rates and low demand and all that. So just I think it's important as a real estate investor to be aware of those variables because they're out of your control. And I think that's a good reason to even, go back to your dollar cost averaging kind of model, and that, if the fundamentals of the deal work today,
Yeah.
uh, and you have some locked in financing that can, stretch far enough to get you through a market cycle, whether it be a
Mm-hmm.
dip or whatever. I feel like those are the things that I can control in a market, and or when I'm ready to pull the trigger. If I have an agreed to price based on the fundamentals and the underwriting I've done, and I have financing that's long enough that can get me through a downturn to where the market is, back and stabilized. It seems to me that those are the things that investors should be, looking for.
Yeah.
Um,
Well,
Go
one
ahead.
thing I wanted to add to your comment about things you can control, and you and I share this belief or philosophy that we pointed out. Investing for cash flow, not necessarily for equity upside. I mean, you can go back and listen to just hundreds of podcasts that I was on prior to all of this happening, and that's always been my philosophy is that I invest for cash flow, and then if the equity upside's there, that's cool. But I never counted on that on day one because there's too many factors out of our control. Take just the Fed themselves as an example. In December of 21 said we're going to raise rates, but we're probably taking it to about 2.25 Fed funds rate in the next few years. Well, they took it to 5.25, right? So nobody, not even the Fed, not the president, nobody could have predicted that's exactly how that would have unfolded. And that directly affects your equity upside. I have this argument all the time with one of my best friends. He's a stock day trader, and he's always trying to convince me of these technical analysis charts. And I'm like, yeah, that's all fine and good as far as your bars and graphs until the black swan event hits, and then it's just, none of that matters, right? That stock's going to fall like 40% no matter what. So it's that type of thing that we have to be aware of. And the good thing about real estate, to your point, is if you buy right and you get the right debt and it's fixed rate and you're cash flowing on day one and you've got room to move these rents regardless of what the market does organically because you're buying something distressed and older and it's got some upside to the rents. Those are the situations I like to be in. It's never a guarantee that that's going to work out for you, but it puts the odds severely in your favor. those deals I talked about as an LP I've been in for nearly a decade, about 9 years at this point, are continuing to increase cash flow today, which is bizarre and weird. It's like the tale of two stories. You have this operator over here that's, looking at losing a deal, and this operator over here that's got 50% LTV and 14% cash flow distributions going out. So something to definitely think about, is the speculation. You're right. Everybody's impatient, and 5 years or less is optimal for everybody. But sometimes it takes longer, to get that result.
In just as you were talking there, the other thing that I've come to really appreciate, especially about multifamily, is that if you have a vacancy, it's one unit, it's not the whole building, like,
Yeah.
versus when you have single family.
Yeah.
And likewise, I mean, I suppose it happens, but I've not heard of let me put it this way, for a normal property with, that's well located in a market that has employment. Okay.
Yep.
There's a demand for housing. Uh, I've not heard of like a 50% everybody moved out in the middle of the night,
Right.
or that, kind of thing.
Right.
There are situations I've seen where people have picked up deals that are in depressed economic areas, that, you have people struggling to pay because they don't have jobs, and there's all sorts of fundamentals there that are problematic to begin with. But just in my experience, a couple of vacancies per month is not like a showstopper. That's more of like a chance to usually get a higher rent than what you were getting.
Yeah.
If the market's softening, you might back off the rent to get it filled, but it
Right.
doesn't go to zero,
Right.
you know?
Right. Or you could give out some temporary short-term concessions, 2 weeks free rent, one month free rent. Sometimes that's actually more cost effective than someone leaving, and then having to hike the rent back up, but it goes vacant for a month or two. So yeah, um, those are great points. And I didn't fully understand the risk profile of single family till after I was out of that business completely. But to your point, when you're vacant and there's just no interest out there, it's a scary time because you're not just zero cash flow, you're in the hole, you're negative, right? So if you were cash flowing $300 a month and all of a sudden you're vacant and you're paying out 1,200 a month, that quickly can eat up an annualized return. And then once you get it, let's say you got that stabilized and taken care of, that's great. But then that air conditioner goes out and it's $5,000. Well, what happened to your 300 a month? There's another
Yeah.
year gone, and so a lot of these deals I look back on, it's like, boy, if it weren't for the market coincidentally lifting the tide, I would have lost money on a lot of these deals, when you
Yeah.
really factor the real numbers in. And so that's what convinced me to look for a different model in the real estate space.
Hey, I want to ask you just along the whole market cycle thing.
Hmm.
Um, there was a huge migration from the northern states down to the Sun
Yeah.
Belt during COVID.
Hmm.
Primarily, I mean, I think of Florida and Texas primarily,
Yeah.
where both states were open for business. People recognize tax benefits, et cetera, and
Right.
moving that way. Um, do you have any kind of sense of, is the cycle exacerbated in these areas? Is it because a market cycle too is local, but I mean we've been talking more in like just general terms, just based on what economic
Hmm.
factors have been in play. But do you have any sense of any of these, more of these Sunbelt markets,
Yeah.
given the where we're at, and where we've come from?
Yeah, I'll give you some real practical firsthand insight here. So first of all, I live in Central Florida. With Joe and Ashcroft, we have a Sarasota property. I'll use that as an example, and we have an Orlando property. In this submarket master plan community. So in Sarasota, what we're seeing is that a lot of supply came into a relatively small market with less job diversification than, let's say, Central Florida or Orlando, by a long shot. I mean, Sarasota is kind of a niche market. And so as our residents have moved, which they do naturally, and we've been checking out these forwarding addresses, we're seeing a lot of Central Florida. So to your point, there was this period where they maybe moved closer to the beach in Sarasota in a different market because they were from Orlando, but they had the ability to work from home and maybe commute on occasion. And now they're going back full time, maybe to the office or just relocating to Orlando for a different reason or a different job. So we're seeing, negative migration in the short term over there, and a lot of headwinds for that market. Whereas with Orlando and this one particular property that we have, it's a master plan community that's just growing by leaps and bounds. I mean, every week it seems like there's new things opening, there's new employers going there. It's 5 minutes from Disney, it's 20 minutes from the airport, it's right next to all these medical facilities. Like, so there we're seeing like $100 a month rent bumps right now, so it's like the tale of like, you know what I mean? Two different stories, similar timeframes to when we bought these deals, but markets can certainly shift that way. So to your point, it depends, right? It's local. It's too hard to say Florida is this, or are we talking about Jacksonville or Miami? Those are two polar opposite. It's like California. LA is not San Fran, and San Fran's not Sacramento. So there's a lot that you got to dive into, but in general, I think Florida's still, keeping pace. And of course, there's all these proposals all the time by the governor, DeSantis, we want to eliminate property taxes, or we want to whatever, help with insurance. So if any of these even partially pass in some form, that's going to be very bullish too. But it's just hard to tell right now, So we've seen a big resurgence in some of those markets that lost a lot of people too. Both in parts of California and Manhattan and New York and stuff like that. But a lot of that was company policy of we're returning to the office and it's mandatory that you come back, stuff like that.
Right. No, I just really enjoy this conversation from a standpoint of just some perspective and kind of get your bearings on, what are the time elements in play, and, the opportunities and just, the nature of the market, and just a good reminder of, what can be and what will be. I mean, there's always going to be these cycle events based on supply and demand, and it's just important to have that perspective going into a real estate investment, so that you're not fully surprised by or taken off guard by these situations, and more information is always better. So I appreciate that.
Absolutely.
Hey, Travis, if we could, I want to shift gears here for a second.
Yeah.
By day, as you know, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. First, look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we're not able to avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your investors, could be the market, the Fed, tariffs, or whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Travis Watts, what is the biggest risk?
I would say in 25, we talked a lot about market and rates and the discounts and why we're bullish or why I'm bullish on multifamily. I would say it's more than ever, it's the operator that you're about to invest with. Okay, do they have a lot of distress on their books? Are they losing properties currently? Are they not? Not that any single answer to that is like a red flag and rule them out, but you want to dive a little deeper and make sure that they're dedicated to staying in this business. Because what we've seen is a lot of these student deals and programs and things, folks that got involved in 21 and 22 doing their very first deals, some of them are walking away from the business. They gave it a few years, they're not making money, they're leaving it behind to do something else, and they're forced selling properties or they're foreclosing. So you just want to be, up on your due diligence with, is this operator gonna survive this storm, and do they have the dedication to stay in the sector, for the next 5-10 years, whatever the business plan is for the deal you're looking at.
Yep, battle scars, battle tested. That's a good thing, especially when you're going into uncharted waters. So that's good. Hey Travis, where can the listeners go if they'd like to learn more or connect with you?
Real easy to remember, hopefully for everyone. Speakwithtravis.com is my calendar. Happy to connect with you on any of this information. We're out there buying these foreclosed deals that are happening right now and below market deals. So if you want to check out some opportunities with Joe and I at Ashcroft, happy to share those as well.
Awesome. Well, Travis, I can't say thanks enough for taking the time to talk today. I, like always, enjoy our conversation. I learned a lot, and look forward to doing it again soon.
Thanks, Darren. Thanks, everybody.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.